questions whenever. You can just go ahead and just ask those questions. So let me get to meet, and I'm from GODP Consulting, and this is an open class on expected credit loss modeling, and I'll be doing this for about 2 hours, maximum of 2 hours, and so that is it. So let me get to meet some of the people here. So just tell me your name. This you can invite as many people as possible. It's an open class, so send the link to as many people as possible. Is for everybody to learn. So what do you want to learn? I just want about 2 people to just tell me their names and what you want to learn from this class. Your name, your company, and what you want to learn from this class. So please, anybody that wants to shoot, you can just go on. You can just tell us your name. Okay, please, anybody can shoot, please. Your name, your company, and what you want to learn from this class.
Yeah, good morning, everyone. I am William Wabuke. I work with Nesto Aviation Services Limited. I've heard so much about ECL. I've tried to even read about it. And I've always been looking forward to a training that will walk me through ECL. So I look forward to being hands-on on this after today's session. Thank you very much.
Thank you very much. I appreciate you. One more person, just tell us your name, what you want to learn, and your company.
Good morning, everyone.
I want to wonderful morning. Good morning.
Okay, yeah, my name is Oluwasegun. I work with IGL. Just like the earlier speaker said, I've always heard about it, so I want to know more about it and how it will help me both in my day-to-day job and my aspirations.
Okay, that's good. So I'm just going to share my thank you very much. I think I can go on then. I'm going to open a blank Excel sheet because everything I'll be doing real life. So I'll suggest you open an Excel sheet too, so that we can do some of those calculations together. So, what is this all about? That's the first thing. We've been doing ECL for a couple of years now, so I assume that it's not a new phenomenon. It's not a new thing. You've heard about it over and over again. So, it's basically to just share some light on what it is. So the standard that talks about IFRS 9, or that talks about impairment on financial instruments, is IFRS 9. And ECL is expected credit loss. That is what it is. Expected credit loss. And that is the model. So before ECL model, we were using what we call the incurred loss model when we were still using IAS 39. But when IAS 39 was replaced with IFRS 9, we started using expected credit loss model for calculating impairment. And what impairment are we talking about here? We are talking about impairment on financial assets. There's a separate standard that talks about impairment of non-financial assets, IAS 36. So that one is a separate thing, really. So this one is IFRS 9. It talks about impairment on financial assets. So the first question will be, before even delving into the guidelines or the guidance of IFRS 9 on impairment, what is impairment? And this class is going to be very interactive, so I'm not going to. I assume that I have chartered accountant, many years of experience, so I'm going to be putting is to develop skills. So I'm not a lecturer really. I was in the class yesterday with a couple of guys all over the world, and the it was a class, but it was a chat. So today we'll be using that strategy, and the strategy will be to discuss and to do it practically rather than teaching, because the people here are experienced people. Yeah. So tell me, what is impairment? What do you think impairment will mean? Anybody can actually shoot, please. Now I need people to shoot. Anybody can talk. What do you think impairment is all about? Anybody? What do you think impairment is all about?
Good morning. Let me attempt the question. Okay. I believe impairment is you trying to see if an asset has lost value over an accounting period.
Wonderful. Whether it has lost value over an accounting period. That's a good way to look at it. That's a good, very wonderful way to look at it. Any other person wants to give it a shot? What's impairment all about?
Okay, we can say an impairment is when an asset suffer, there's an adverse effect on an asset. You can see that asset has suffered impairment.
Wonderful. Thank you very much. Okay, so Dorcas, you can go ahead. You can say yours.
I said impairment can occur when an asset suffer an adverse effect.
Yeah, I got that. Thank you very much. Thank you very much. I got that. Okay, so Dorcas, noise is coming from your side. You can go ahead and.
Can you hear me?
Yes.
Can you hear me?
Yes.
Yeah,
Go ahead.
so impairment is a sudden fall in the economic value of an asset.
That's beautiful. Okay, so thank you very much. So, what is impairment really? Let me try to explain it probably more practically, and because everybody has explained it theoretically, which is beautiful, really. That is, if you write that one in an exam, you are passed. So, impairment in itself basically is just looking at value of an asset. Now, but in this case, we are looking at the value of financial assets, not just any kind of assets. Whenever you buy an asset, the reason why you pay for it is because you have the opinion that that asset will give you economic benefit for more than a year. Yeah. So that is why it's not an expense, really. That is why it's not. Many of them are actually non-cost. So if it will give you economic benefit, probably for 1 month, 2 months, more than 3 months, more than a period, you will say that basically I have an asset. Yeah. Now, if I have an asset, the reason why I'm paying so much for it is because of the value I expect to get. In a situation where the value I expect to get has now become lower than the amount that I have in the books, then I will be talking about impairment. Let's put it this way. In a situation where the recoverable value and I have carrying value is the same thing as the book value. So in a situation where the value I have in my books is far more than the value that I can get from either using it or selling it or any other thing with it, then I will say I have impairment. So impairment will exist if carrying value is greater than recoverable value. That is when you have impairment. Please, does that make sense? Did we get it? When the carrying value is far more, and the carrying value is the value in your books, when it is more than the recoverable value, that means the value you can recover from it, whether by sale or by use or by any other means, then you will say you have impairment. That is just to explain what impairment is in its own sense, without having to look at financial instruments or not. So that is what impairment is. So if this is what impairment is, then we want to talk about impairment of financial assets now. Meaning, you could buy a bond, and that bond's value in your books is so big but that bond can never be sold again. Let me give you a practical example with many clients I've seen. So you will discover there are some instruments that you buy, whether they are bonds or they are any kind of instrument, and those instruments, you cannot sell them any longer. Nobody wants to buy, and at the same time, the issuer is not actually giving you any repayment of your principal or interest. At that point in time, you would have a book value, but they are supposed to be giving you dividends or interest repayment or principal repayment, and they are not paying you any longer. In your mind, you know that, though in your books, you have the value as 500, but really, the value of this thing cannot be 500 because they are not paying you the way they should be paying you. At that point in time, you will say there is an impairment on that particular instrument. So having explained that, let us go into what are we supposed to be looking at impairment for when it comes to financial, when it comes to IFRS 9. The standard says to us that you don't need, so there are basically three classes of financial assets. And those three classes of financial assets, remember, you can never impair a financial liability. It is only on an asset you can have impairment. There can be an impairment on a financial ability. And number two, also remember that you cannot have an impairment gain. It's impossible. Yeah. So it's only deterioration in the value of an asset. You cannot have a gain from it. You cannot have an impairment gain. Yeah. So classes of financial assets in itself, from IFRS 9, you have fair value through P&L, you have fair value through OCI, and you have amortized cost. I believe you understand this already, so I'm not teaching you this. So these are the classes of financial assets. So the standard is now saying, when it comes to impairment of these financial assets, what are those things you should focus on? The standard is saying, when it comes to fair value through P&L, no impairment required at all. When it comes to fair value through OCI, yes, impairment could actually happen here. Yes. When it comes to amortized cost, yes. So let me put it the way the standards puts it. So they are basically, it broke it into 5. But you see, it is just across those 2 that I just explained. You would have to consider impairment for instruments, financial instrument measured at amortized cost, 1. You have to also consider impairment. So you are doing it for instruments that are measured at amortized cost, but the standard went a step further to now say, in addition to that, do for also trade receivables. But you see, trade receivables by nature, they are also classified as amortized cost. But it broke it down to say, also do for trade receivables. It also says that we should do for lease receivables. And we should also consider impairment for instruments that are at fair value through OCI. And we should also consider impairment for financial guarantees and commitments. These 5 are those ones that we should consider for impairment. The scope of impairment under IFRS 9 is along this. We should consider it for impairment for financial asset measured at amortized cost, financial asset measured at fair value through OCI, lease receivables, trade receivables, and loan commitments and financial guarantees. Those are the only ones that you will consider for impairment. Now, because these are professionals in the class, this is not a university classroom, then let me ask a question. Why do you think we are not considering impairment for fair value through P&L? Does anybody want to help me? Hello? Why do you think the scope of IFRS 9 impairment will not be considering for this? What do you think? Anybody wants to give it a shot? What are we not doing for fair value through P&L? Let me go and look for somebody to call. Why are we doing impairment for fair value through P&L? Do you want me to call names? Anybody could just help me. Why are we not doing impairment for financial assets that are measured at fair value through P&L? Go ahead, please. But you need to unmute to talk. Everybody is muted, so if you are talking, I can't hear you. Okay, you can go ahead, please. Why are we not doing impairment for instruments that are measured at fair value through P&L? Okay, what do you want to help? Oh, there's a lot of noise. Okay, let me go on. If I can't see anybody helping me to answer that question, so I will just take it a step further. So basically, you are not doing for fair value through P&L because it's already measured at fair value. And fair value, basically, remember that it's like the value you use to either buy or sell the instrument. Because somebody said, because the loss or profit will be recorded in the bank's books directly. You're right. However, the reason is because fair value includes market value. Fair value includes the value of that asset as at that year end. So if I have already stated the value of that asset as at that year end, that means that even if I had done, remember that if we had done a fair valuation, it would have almost resulted in the same thing. If I had done impairment, I would discover that that instrument, the value of that instrument that I'm also calculating, has been taken into cognizance. So to an extent, the impact, like you said, has already hit P&L. Whether if it's a fair value gain, it has hit P&L. If it's a fair value loss, it has hit P&L already. So to an extent, you don't need to redo it again because the value is already at market value or fair value. Let's put it that way. Yeah. So I don't need to do it for that. Yeah. So that we can. So let me take it a step further. Now that we know what we are doing this for, next question will now be, what is the guidance of IFRS 9 on this? What is the standard saying about IFRS 9? So about impairment, let me put it using this simple example. The way the standard looks at it is as if we have three buckets. Please, just look, this is the guideline. This is what the standard says in IFRS. There are three buckets. The first bucket is called performing bucket. Second bucket is underperforming bucket. And the third bucket is non-performing bucket. But our definition of performing or underperforming or non-performing under prudential guideline might not exactly be. So we need to actually also look at our business to determine what performing will mean. And I will explain. For example, somebody comes to bank ABC to borrow money. The person is coming today. The person, when he came, he borrowed a car when he was coming. He borrowed suit. He borrowed even bank statement of somebody to come and show the bank that I have money, you give me a loan of 500 naira. Now, the moment the person collected the loan, he carried his bag and jackpot to Canada that same night. If you use our prudential guideline will say he's still performing until, let's say, 90 days or 30 days. I'm just painting, and 30 days, you are saying he's still performing. It has not even, this thing, it has not defaulted now because he's supposed to be paying, let's assume it's monthly or quarterly. If it's quarterly, you are waiting 90 days. If it's monthly, 30 days. In 30 days, you are supposed to wait for him for the repayment to be due. But this guy ran away to Canada that same day. The question is, how would you classify the loan under IFRS 9? Because from that same day, even in reality, if you add the information that he ran away from Nigeria that night, you know that it is that same day that that instrument became non-performing. Because he ran away with all of his family members. He's not coming back. Meaning he just collected the money and he never has an intention of paying back. That means the risk is not the same thing again from that day. You don't need to wait for 30 days because it has gotten spoiled from that first day. So that means the view lens that you use to look at performing or non-performing or underperforming is not just the number of days past due. It is now a measure of the credit risk. Because classification was based on prudential guideline was strictly based on number of days past due. However, in reality, in the example I just printed for you, you know already that that loan became bad on that first day. So the standard is saying it will be performing, or what we call stage 1, we call performing stage 1, we call underperforming stage 2, and we call non-performing stage 3. It is performing when measure of credit risk at subsequent measurement date. Subsequent measurement date is like reporting date, like 31 December 2025. When credit risk at subsequent measurement date is less than or equals to credit risk measure at initial recognition date. What does that mean? What I'm saying in essence is that means you are supposed to have measured the credit risk when the client is entering into the loan portfolio at initial recognition. You're also supposed to measure credit risk at reporting date. If there is no significant increase or the credit risk at subsequent measurement date is now smaller than the credit risk at initial recognition date. Hello, can you hear me? Hello, can anybody hear me?
Yes, sir, we can hear you, sir.
Okay. Please, can you still hear me very well?
Yes, we can.
Okay, so that's
Yes, sir.
okay, that's cool. So I said when the credit risk as subsequent measurement, let us put it as, and the measure of credit risk is PD lifetime. I'll be teaching us as much as I can in this class. The measure of credit risk is probability of default lifetime for the instrument. So if the probability of default lifetime as initial subsequent measurement is like reporting date is smaller than the credit risk measure, which is the PD lifetime at initial recognition, you will put it in stage 1. Or if credit risk at subsequent measurement date is equal to low risk, that means in your portfolio analysis, in your credit policy, I want to believe that every company, let's say every company has a credit policy. And within that credit policy, you determine what is low risk. For example, risk is between 0 and 1. For some companies have said that, oh, if the risk measurement is between 0 and 0.2, it is low risk. So even if it increased from 0.00001 to 0.2, that thing has increased by about 20,000%. But even if it has increased by 20,000%, if the risk is still low, it will be in stage 1. Because if the PD, probability of default, is 0.2, that means the probability of no default is 0.8. And if you have probability of collecting your money 80%, you have already passed now. So to an extent, when it is low risk, it will still be in performing. So at what point does it enter under performing? And the third one is that before it leaves performing, if the measure of credit risk at subsequent measurement dates is now greater than credit risk at initial recognition date, but the difference or the movement is insignificant. If it is insignificant, we will still put it in stage 1. What do I mean by insignificant? Insignificant at this point is looking at, something could have moved from 0.001 to 0.02. Now, if you look at that movement, it has moved. It has moved from 0.0001 to 0.0002. The mere fact that it moves, if you look at that, the probability of no default is still 99.998, meaning that the probability there will be a default is inconsequential. Yeah, and if it is inconsequential, the movement in credit risk measure from initial recognition date to subsequent measurement date is insignificant. We will still put it as performing. So at what point does it end up underperforming? It enters underperforming when credit risk measure at subsequent measurement date is greater than credit risk at initial recognition date, and it is what? A significant move. It is a significant move. At this point, we will say it is in stage 2. And when is it in stage 3? It is in stage 3 when credit risk at subsequent measurement date is approximately or equals to 1. At that point in time, we are saying the measure of credit risk has almost shown us that we can collect. So in some companies, they have said that, whenever it is 0.8 and above, we assume that the money might not be coming in again. Based on history. Remember that this is not an assumption in the sky. This is all about historically. Whenever the PD has become 0.9, do you always recover it back? If the answer is no, that means your threshold for non-performing is 0.9. We have not spoken about how the PD is calculated or how the measure of credit risk is calculated. We'll look at that as we go. So this is what enters stage 1, what enters stage 2, and what enters stage 3. Any questions? Can I take it a step further? I just need to be sure that I'm talking. I'm not talking to myself. If I'm talking to myself, then hello, please. Can somebody just say, if you say I, that means I know I should continue. If you say nay, that means we should close the class. If I don't hear anything, that means it's average.
Aye.
Okay. I just wanted to be sure that, okay. So if this is stage 1, thank you very much, stage 2 and stage 3. So at this point, thank you very much. So at this point, what is now the standard saying? Now we have classified them using the standard. What should be done? The standard is now saying the ECL model to use. The ECL model to use in this situation. The first one, it says we should use what they call 12 months expected credit loss model for all the ones in stage 1. And it says that for stage 2, we should use the one called Lifetime ECL model. And for the one in stage 3, we should also use Lifetime ECL model. That is what the guideline asks us to do. So the first thing, before you can determine whether it's in stage 1, stage 2, or stage 3, is to calculate the credit risk. Not just at reporting date, but also at the beginning of the instrument itself. And if there's a significant increase, use Lifetime ECL. If it is not a significant increase in credit risk or the credit risk measure has reduced, use 12 months ECL. So this is the guideline of the standard in a summarized form. Let's take, now if you look at this, there are specific things that I have mentioned that might look a little bit fuzzy. 1, I measured measure of credit risk. 2, I measured that credit risk is measured using PD, probability of default. 3, I measured 12-month ECL. 4, I measured lifetime ECL. Next, I also mentioned significant increase or significant change. Yeah, all these things that I measured, let me try to explain them one by one. As we go on, I'll just begin to step into them one by one. So this is the guideline of the standard, and that is what I just explained on Excel for you. When there is a significant increase in credit risk, it will be in stage 2 or stage 3. Yeah. Having said that, let me first start by explaining what. I mentioned I mentioned that 12-month ECL, lifetime ECL are those things that I've not even explained. So let me begin to explain the concepts in a very simple way. What is credit risk? Credit risk is the risk that an obligor will default. So in most cases, credit risk is deemed to be a risk of default. However, credit risk is bigger than the risk of default. That is why in risk management, we actually have expected credit loss and unexpected credit loss. However, the one that IFRS 9 focuses on is just the expected one alone, meaning it's looking at just the risk of default. But when we begin to look at the full nomenclature of credit risk, we'll begin to look at things like concentration risk. Because you see, if you give loan, for example, or you sell financial instrument like a bond to people in Sambisa forest, and they have money when you sold it to them, all of a sudden, USA bomb all the people in Sambisa forest. As a result of the fact that they bombed one place, even the one that they have not bombed would have carried his load and ran away. And as a result of the fact that that particular business is located around where they bombed, the business might become, might not exist again. Why? Because the owners will run away for their lives. And if they run away for their lives, they might not be able to do business to repay you the loan that they borrowed back. You will discover that by them being in a particular location, a concentration, there's also a credit risk, which is bigger than the risk of default. Default is just that the obligor cannot pay. But the mere fact that you are located in, say, for example, Sambisa Forest, there's a concentration risk, which is also part of the credit risk. But from the perspective of IFRS 9, we are focusing on default risk. And the way we calculate default risk in a very simple way, one of the ways we calculate it is using what we call the probability of default. Now, I need to explain that the probability of default is not a measure of creditworthiness. Now, that is what I've seen many companies do. So we help a lot of companies, a lot of banks, microfinance banks, to calculate PD. And what I've discovered, one of them, a finance house, a very big one, was explaining to me the way they were doing it before. And their auditor was EY. And they say, the guy was telling me they just pick a figure 0.5, 0.8. And my question is, where did you find the figure? They say, like, you assume. I say, from where? Because the question is, a probability of default is not what you pick in the sky. What is probability of default? Probability of default is the probability that an obligor will not fulfill his contractual obligation. So let's assume that we are giving a loan. Let me confirm. Hope I'm still communicating. I assume that I'm still communicating. Let's assume that hello?
Yes, sir.
Okay, please, I'm sorry. Okay. So, the probability of default effectively is focusing on that credit risk. And I'm trying to explain that it is not credit worthiness. I want to explain the difference between the two to you. Somebody came to actually, somebody came to your company to come and borrow money. And the person actually borrowed for 3 years. When the person came, you ask the person to bring bank statements. You ask the person to bring pay slip. You have the person to bring his father's house as collateral. Let's assume you ask all of these things. Now, after the guy brought all of those things, and you are like, oh, this guy, you have enough money to pay back in the future. So you gave the person the loan. All of those things that you assessed before you gave the person the loan is what they call credit score. So at that point in time, you were scoring the person's credit worthiness based on information provided. However, by scoring the person that is a good person on day one is not probability of default. Because the probability of default is now considering whether the person will be able to pay what he's supposed to pay month 1, which is future, month 2, which is future, month 3, which is future, year 2, which is next year 3, year 4. That is what probability of default is concerned about. So you cannot use the measure of credit worthiness as the PD. In this class, I will try to see as much as I can help you to calculate probability of default, because probability of default is calculated statistically as a relationship between all the credit scores that I just explained from your credit scorecard versus history of default or no default of those kind of people that have taken loan from you in the past. Yeah. Okay, so that is actually probability of default. So it factors in the future. So it is a statistical calculation, and I'll try to teach you how to calculate it. It is always between 0 and 1. 0 meaning you don't go collect anything again. 0 meaning that there's no default at all. 1 meaning it is a perfect default. You won't collect anything again. And like I said, PD lifetime is a measure of what? Credit risk. Now, when you're now looking at 12 months, please, do we understand the meaning of probability of default now? Can I take it a step further? If you don't understand, give me a thumbs down. I think you have this and stuff. Raise your hand if you don't understand, so that I can just try to explain it shortly. If you don't understand what I just said, and if you do understand, give me wave if you understand, so that I can take it a step further. If you understand, okay, so let me take it a step further. I assume that the hand raised means you understand. Okay, taking it a step further. Okay, taking it a step further. What is 12-month ECL and what is lifetime ECL? Remember, I explained that there were models of ECL. What is 12-month ECL? Now, the way we calculate ECL basically is always from the Basel Accord, because it has been in risk management before IFRS people copy and paste it. It's copy and paste that they did. So the way we calculate ECL, which is expected credit loss in risk management, is that it is equal to probability of default times loss given default times exposure at default. This is the way we calculate it in risk management. So in risk management, if we want to know how much loss could you have, it will be a measure of the probability of default, loss given default, and exposure at default. So before I begin to talk about 12-month ECL or lifetime ECL, I think I should first talk about ECL. expected loss. So what is expected credit loss? Let's put it this way. Expected credit loss is probability weighted credit loss. I'm just defining for you. Expected credit loss is equals to or is probability weighted credit loss. That's why we call it expected, because you are not sure. Somebody is telling you calculate what the loss will be for somebody that took a 5-year loan throughout the life of the thing. And the question is, how would you know what will happen in the future? So that is why it is saying there's a credit loss. So I said, so the probability weighted credit loss is basically looking at the probability of that loss either occurring or not occurring. So within this definition I give, you have probability. Let me try to break down the components of the definition. So within this definition, I put probability, I put weight, and I put credit loss. Those are the three things inside this definition. Yeah? And I'm defining ECL, not 12-month or lifetime yet. So I said probability here is looking at the probability that the loss itself will occur or it will not occur. And to calculate that, we use probability of default. What is credit loss? Credit loss is calculated as the present value of cash shortfalls. Credit loss is the PV of cash shortfalls. What is cash shortfalls? Cash shortfalls is equals to contractual cash flow minus expected cash flow. What is contractual cash flow? It is the flow as a result of the contract. So you tell them you are supposed to be paying us back 50 naira every month. That is contractual cash flow. Yeah, you say pay us 50 naira at the end of each month. That is contractual cash flow. And expected cash flow is now how we think the person will pay back. So let's try to put this, that I'm only trying to define ECL for you. Let's try to put it in a mathematical calculation, a very simple one. That means if we are to calculate ECL, I said it is PD, the weight, and the credit loss. So PD, I said is between 0 and 1, and I said I will teach you how to calculate it. So hypothetically, let us say PD is 0.2. I will still teach you how to calculate it. The weight, let's leave that. Let's go to the credit loss. I said credit loss is the PV of cash shortfalls. And I said cash shortfall is considering contractual cash flow and expected cash flow. And I explained that so cash shortfall is the difference between these two. So let's assume that this loan is a 3-year loan and it's supposed to be paid year 1 to year, let's say year 1 to year 3. We assume that the person is supposed to repay 2020 every year. However, expected cash flow is now saying based on information available to you, the people in your recovery department, they have such information. They know that this one, you know, go pay. An issue with already. The guy has told you already. So let's assume the person might not be able to pay now, and the person subsequently after is expected to be able to pay. optimally, and afterwards the person will be able to pay continuously. So the cash shortfall is equal to contractual cash flow minus expected cash flow. In this case, this is the cash flow projection. This is cash shortfall. Let's assume that the rate was 20%. So in this case, let's assume that these are now the cash, not assume we have calculated it already, these are the cash shortfalls. So the credit loss, let us calculate it, is equals to the PV of the cash shortfalls, which is equal to NPV, open bracket. The rate in this case is 20%, comma. And all the cash shortfall from year one, okay. So in this case, the credit loss is actually 2.78. But if you look at it, if you add everything together, you will discover that somehow the person is not owing anything, because what he was supposed to pay in month one or year one, he paid in year two. So really, he's not owing money. But as a result of the fact that he did not pay when he was supposed to pay, there is a credit loss. So this credit loss here is this one. So this credit loss is the same thing we calculate using LGD, or loss given default. Because with loss given default, we are looking at loss as a result of the fact that the person defaulted in paying when he should pay. Probability of default is looking at the probability that a default will occur. So you can't have a loss given default if there's no probability of default. So in a situation where the probability of default is 0, LGD will be 0. But in a situation where the probability of default is, let's say, 0.3, but the person now be paid back 2 months after, his loss given default will be different from somebody that defaulted in year one, but he did not pay until 24 months after. In that case, the loss given default will be bigger. So if you look at it, probability of default is looking at horizontal, loss given default is looking at vertical dimension of credit risk. One is looking at whether default will occur, yes or no. The other one is looking at if default now occurs, what is the loss as a result of that default occurring. So those two dimensions is the way we measure credit risk. So this ECL now, let's assume the weight here in my definition is considering what is the weight that these our probabilities will even occur. At this point, we are bringing in scenarios that are Nigeria will become better. Scenarios that are when Nigeria become better, that means that people will be able to pay faster. So bringing in those scenarios, because we are not sure of these expected probabilities that we're actually calculating. So because of that, we need to bring in what we call forward-looking information. And bringing in those forward-looking information is bringing in the weights. Let me assume something here now for now, and I'll say the weight is, let's say, 90%. So that means, by definition, remember I'm just defining for you, that means that ECL, in this simple example, I'm only defining, I'm not calculating anything, is PD times the weight times the credit loss, which is the LGD. So in this case, this is the expected credit loss by definition. Now, when they now start talking about 12-month expected credit loss or lifetime is expected credit loss, what does it mean? The difference is that if I'm looking at lifetime, I am considering the total life of the instruments. If I'm looking at 12 months, I am only considering the ECL if loss event will only occur in 1 year after that period. That is why we call it 12 months ECL. We are only considering a loss as a result of the fact that the person will not pay back 12 months after year end alone. But when we are looking at the lifetime, we are considering the total life of the instrument, like I did here. Please, do you understand the meaning of 12-month ECL and lifetime ECL now? So, Olaide Oyelere, you actually have your hands up. So, do you have a question? The question is no for me. Okay. So, any questions? Please, do you understand 12-month ECL and lifetime ECL? Please, do you understand this? So, 12-month ECL is focusing on the expected credit loss if a loss event occurs in the next 12 months. And lifetime ECL is looking at the ECL amount in a situation where the loss event occurs anytime throughout the life of that particular instrument. I'm going to try as much as possible within this period to teach you how to calculate some of these things because they are straightforward, they are just statistical. So, do you understand? I need to be sure that I'm not there talking to myself. Please, do you understand? Okay. Okay. So somebody is saying, I don't understand how to calculate 12 months ECL. Okay, let me also see. Please, I don't understand how to calculate 12 months ECL. Now, what I've done here in this Excel, I've not calculated anything yet, though. I'm only defining for you. So, by definition, 12-month ECL, if I'm going to do by definition, it means I will not consider year 2 and year 3. Please, do you understand me now? The person that put that, I want to believe you are looking at the screen. So, in a situation where I only consider 12 months after year end, which is year 1, that is, he's telling me that the ECL will be, so you need to, you are considering only the period 12 months after alone. That is what 12-month ECL is. And if you are considering after that, is as in all the whole life, is what lifetime ECL is all about. So remember, when you are considering 12 months after, there's every probability that you're actually having a probability of default that, we still expect to collect 0.8. I'll teach you how to calculate the PD. Like I said, I only just assume something so that I can define. So 12-month ECL is only considering that a default will occur in the next 12 months, while lifetime ECL is considering any default throughout the life of that instrument. The person that asked that question, have I explained? Please, if you still don't understand, tell me. I'm trying to actually just take the questions as I go on. Please, do you understand? I just need a response to take it a step further so that I will begin to show you. I want to see if I can show you how to calculate PD in real life. Yeah, before I look. Please, I want a response to you understand. Okay, so Nneka said yes, so I assume Nneka is talking for everybody. That's my answer. So, yeah, the standard, so this is it really. Everything I just explained to you on Excel, this is it. It says credit loss is the difference between all contractual cash flow and all expected cash flow, discounted at the effective interest rate. That's what I just did for you on Excel. And ECL is weighted average of credit losses, which is probability weighted credit losses. 12-month ECL is the portion if the loss event occurs in the next 12 months. Lifetime ECL is throughout the life if there will be a default event. So that is what I just explained on Excel for you to you. Now, let me also remind you that I said you can only do 12-month ECL when it is low risk or there's no significant increase in credit risk or credit risk has even reduced between initial recognition and subsequent measurement date. Yeah. Now, I want to now go to, remember I told you I wanted to define a couple of things. I have defined credit risk, PD, ECL, 12-month ECL. lifetime ECL, let's now go to significant increase in credit risk. So what is significant increase in credit risk? In reality, how do you determine it? I'm going to speak about it theoretically first. Theoretically, what is significant increase in credit risk? So the standard has helped us to just give us some ideas. Number one, whenever there's a change in credit risk over the life, you are looking at a situation where there has been a default. Yeah, for example, where more than 30 days past due, and this is actually rebootable, saying that credit risk has significantly increased if the person has not repaid you back 30 days after when he's contractually supposed to repay you, or the financial instruments credit rating has significantly dropped, meaning that the instrument is not doing well again, or in a situation where number of days past due self has become more than 90 days. When it's more than 90 days, you are saying that there's a default. So in that case, you are saying that there could have been a default. Now, all these guidance from the standard are rebootable. What I mean by rebootable is that if it were to be a weekly loan, you won't wait for 30 days. If it's a weekly loan now, for example, and you give the person 5 weeks, if the person does not pay you after 1 week, you will know that that is when you will begin to know that there's a significant increase in credit risk. So that is why it's rebootable. It's now a function of the situation where you find it. And this is one of those things that helps you to determine whether it is in stage 1, stage 2, or stage 3. But like I said, it is not just about the number of days, it's a measure of the credit risk. But some of those things you should consider in determining what credit risk could be would now be things like number of days past due, and including other things like if, for example, the internal or external risk rating of that particular obligor has dropped. For example, his credit bureau rating. His credit bureau rating is now very bad. That is one of those things that shows that there's a significant increase in credit risk. Another one could be that, the person is supposed to be repaying you back from his operating losses and his operating results, and his operating profit has now dropped or is expected to drop. Let me give you a real life situation. Many companies invested in Visionscape when Ambode was there. Some companies, even when the Visionscape began to have problems, when it began to have problems, even before Ambode left, you will know that there's a significant increase in credit risk. Because if the government have said, we are going back, we are not sure whether we are going to do this Dubai kind of waste management any longer, and on and on. If they begin to shift back small like that, know that already there's a significant increase in credit risk, because it is not just the one that is actual, it's also the one that is expected. So for example, you gave a loan to a company. The company, you gave him a moratorium of 90 days. However, the contract that the person is supposed to use the loan to do, he lost the contract. If he lost the contract and you have disbursed the money, you don't need to wait until the date the moratorium expires, because at that point in time, you already know that expectedly there might not be enough operating profit or operating results to pay you back, because he has lost the contract that he's supposed to use it for. So if there's an increase or a significant change in expected or actual operating results, it will also have an impact on significant increase in credit risk or not. Or in a situation where the person collected 2 loans from you, is repaying one, is not repaying the other. That one that is repaying also have a problem, even if he's repaying the other ones, because very soon he's coming to come and not repay the remaining. He's coming small. So to an extent, you need to begin to look at also the instruments of the obligor beyond the ones that you give them. So all these things are actually example of the things that the standard gave us as things that could connote that there's a significant increase in credit risk. But I want to read out one to you, and you will just tell me if there's a significant increase in credit risk or not. This is a contract. So I just want to get your idea. Is there a significant increase in credit risk? Yes or no? Bank X provides a tranche of a secured loan facility to company Y. At the time of origination of the loan, it was expected that company Y would be able to meet the covenants for the life of the instrument. Generation of revenue and cash flow was expected to be stable in that industry over that time. However, there were some business risks related to the ability to grow gross margins within its existing business. So there are risks. At initial recognition, Bank X considers that the loan is not originated credit impaired. However, subsequent to initial recognition, company Y has underperformed on his business plan, meaning he's supposed to be selling 5555. He's now selling 2222. Okay. Then company Y has increased his leverage ratio, meaning he has taken other loans beyond the one he took from you. There are other receivables that he now has. Company there are other payables that he now has. Company Y is now close to breaching its covenant, but it has not breached it yet. It's still paying everybody well. Trading prices for company Y's bonds have decreased. Market spreads have increased, not explained by changes in the market. And lastly, Bank X expects a further deterioration in macroeconomic environment, but there has not been any default yet. What do you think? Is there a significant increase in credit risk? Now I need somebody to answer me, and why? Like I always ask. Please, can you just tell me, is there a hello?
Hi.
Yeah, you can fire that, please. Yeah, please, go ahead. Is there a significant increase in credit risk? Hello? Anybody wants to help us? Is there a significant increase in credit risk? Okay, so let me read. Somebody said yes. Let me just read from the comment. So is there a significant increase in credit risk? I think somebody said yes.
Hello, good morning.
Okay. Go ahead, please.
Hello?
You can go ahead, please. You can go ahead.
Yeah, I think so far there is a significant increase in credit risk because the obligor at a point in time could not meet the debt obligation. And from the scenario printed, it is gradually showing that the obligor is having more stringent conditions that will make him not to be able to meet up with his debt obligation. So with that, I think this risk is significantly increasing. So thank you.
Okay, thank you very much. So that's a very good one. Now the sincerity is that you don't need to wait until they don't pay or when they default, because in this case, there's a significant increase in credit risk already, even if they have not defaulted. But like this stuff said, is that there is already a risk as a result of the fact that is already getting difficult for the company to pay, though they have been paying everything they should pay, but they are taking more loans, and where they are supposed to be getting the money to repay from, which is from their revenue generation, they have also done badly in that one. So meaning that very soon, they might not be able to pay. And the moment it is very soon, at that point in time, just go ahead and send and just assume that there's already a significant increase in credit risk already. So that is basically the idea for. So already there's a significant increase in credit risk in this particular one. Yeah. So very quickly, I'm not going to take too much of our time because the time is flying. So that is how you determine. So when you're looking at significant increase, let me take this one because this one might be very interesting. Because when you're looking at whether there's a significant increase in credit risk, you also need to consider everything, including collateral, securitization, collateralization. You need to consider all of those things. Let me paint this, or let me just ask the question. If you give a loan to a company, and that company already brought a collateral that will repay the amount of the loan 3 times, and the collateral is already with you as the person giving them the loan in your office, and now that company has not paid back on their loan 2 months, is there a significant increase in credit risk? Please, do you understand my question? It's about the same question I'm asking here. I said you gave a loan to a company, and the company has not paid you back for 2 months. In addition, that particular company has a collateral that can pay you back your money 3 times and still remains something. Is there a significant increase in credit risk? And you knew this already,
Yes.
that the company might have that. So is there a significant increase in credit risk?
No, there's no significant risk.
There is a significant increase.
Why?
Since the value of the collateral can pay back the loan, there's no significant risk.
Okay, so I need to also explain this. Collateralization is very important when you are considering if there's a significant increase. Remember that at the very beginning, when you are quantifying the risk of that particular institution, you have already factored in that would you be able to pay back, and you discover that the industry of this guy is very volatile. And in a situation where it's very volatile, you have asked him to bring collateral that will be able to pay multiple times. You have collected it already. So his credit risk measurement at initial recognition is already high. So if they are now underperforming, you know that they will underperform before. That was why you asked for collateral that was big enough. So it is all about the measure of credit risk at initial recognition and subsequent measurement dates. All about that. So you must have measured the credit risk before you know that there is this or there is that. Now, I want to take it a step further to now talk about how do you measure ECL, because I think I've done a lot of introduction, because I've just been doing introduction since. Let us try to do some level of calculation together. So how do we calculate? So like I said, when we are actually, let me just speak English a little bit. When we are calculating ECL, we are going to be factoring in past events, current events, and future events. Why? Because we are trying to calculate the future. That is why we say it is 12-month ECL, meaning expected credit loss in the next 12 months. But how sure are you of what will happen in the next 12 months? Or when you say ECL lifetime, you are saying ECL for the life of an instrument that is 10 years. How sure are you of what will happen in 10 years? So we are factoring, and that is why we'll be using a lot of forward-looking information. Now, I'm going to just try to jump because of our time, and let me just try to teach you how do you calculate some of the components of what you calculate in ECL. I explained some minutes ago that when you want, in reality, what we use is ECL is equals to PD times 12 times LGD times EAD. And I explained that this ECL is not what we are calculating in IFRS 9. What we are calculating is 12 months ECL. That means 12-month ECL is equal to PD for 12 months times LGD for 12 months times EAD. So also, lifetime ECL is equal to PD for lifetime times LGD for lifetime times EAD for lifetime. The same thing for this one. Please, do you understand what I'm saying? I think if we are not talking to the class, please, you can just mute so that we can all hear ourselves. Okay, so I think I can hear a noise. Please, if you are not talking to every one of us here, you can just mute. Okay, so I just explained that 12-month ECL, lifetime ECL, these are the ways we calculate them. These are the ways that we calculate them. So if these are the ways that we calculate them, so how do we do this in reality? So I need to begin to teach us how to calculate PD. So there's someone that is still talking. Please, admin, can you help me mute everybody so that okay, so how do we calculate PD? Now, I'm going to teach you how to calculate it in a very simple way, but statistical. To calculate PD, I'll just go straight to it. Probability of default is calculated in two ways. We call one the standard, and the standard model is, it works more in a situation where, standard or market-based, it works more in a situation where the instrument or the obligor is rated. So if the obligor is rated, you can just use S&P rating, look at the rating, and go to the can admin help me mute everybody so that we will not be disturbing everybody? Yeah. Okay. Okay. So going forward, so how do we calculate this PD? How? Very simple. And I'm going to be using this flow. I said PD is calculated as exponential of logit over 1 plus exponential of logit. Don't worry, even if we don't finish in this class, because I have less than 40 minutes, we are going to have, it's a 3-day class. So you are going to join us so you can actually learn it better. Now, exponential, I'm going to teach you PD. I want to try to finish PD at the very minimum. I said there is standardized and there's IRB. What I want, and standardized will only work in a situation where the obligor is rated. Many of the loans are receivables. The sincerity is that the obligors are not rated, so you cannot use standardized. What you can use is the IRB, internal risk-based, which is the empirical approach. And in the empirical approach, the probability of default is exponential of logit over 1 plus exponential of logit. Let me put it this way. Let us do it. We use this 5-step to actually calculate the probability of default. Let me try to do that as fast as possible. Let us calculate PD together. To calculate PD, the first thing we have to do is the scorecard. Now, there are many ways to calculate it. You can also use what they call the migration matrix. We actually use the two, scorecard or migration matrix. But I'm going to teach you the scorecard very quickly because the scorecard is more what many companies really do in practice. So let's assume we are doing for a salary-based lending. Salary-based lending. I know many companies have salary. So this same thing you do for receivables, but I'm just using a loan in this case because they all have the same characteristic. It's just that receivable, there's no interest rates. Okay, salary-based lending. So let me ask, and I want somebody to help me. What are those things that you assess when you are giving a salary-based lending? I want somebody from within the class to help us. What are those things that you assess? Things like bank statement. What are those things that you assess so that, please, if you want to say something, you can unmute or you can just send it. What are those things that you assess to give somebody a salary-based lending? Everybody is muted. You can unmute to talk and mute when you're done. Please, I want some people to just help me. What are those things that you assess from the obligo before you give them salary-based lending?
Hello, good morning.
Good morning.
Okay. Sorry, it's not what I practice presently. I just want to try and say something. For some of us, we have organization in our organization. We still have gratuity, so we consider certain things like that. We also consider length of service and the probability of the person leaving. So, but basically, the biggest is the gratuity.
Okay. Okay. Thank you very much. Okay. Okay. So I have So let me just go and open. I'll just bring everything that we have said. Let me try to open this. So somebody put 4 things here: pay slip, ratio of another person put ratio of salary to loan, type of company, length of service. I think we have all said well. So spoken well. So I'm just going to copy another person bank statement. How long? Very good. So let me just take some of the things that you have said. Now, these things that you have said, that you just told me, is what they call credit attributes. That's what they call credit attributes. They are components of your credit scorecard. You are the one that gave it to me. Salary structure. Salary structure, there is a ratio of gross loan, then the type of the company, then the length of the service of the person. Let me also put that what is it? Number of days past due is also very important. That's even the one that that's what is in the prudential guideline of many companies or many countries. So salary structure. Let's just use, okay, let me see. Is somebody putting something else? And then somebody put pay slip, whether the person has pay slip or not. Okay, which is all good. Please, are we still together? Are we still together? Hello? Okay. 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 So now these credit attributes, they don't all carry the same weight. When I mean the weight, I'm talking about which one is more important in assessing the credit worthiness of an obligor. You know that they don't have the same weight. For example, you are looking at the ratio of gross loan to loan and length of service and salary structure. They don't all have the same weight because one is more important than the other ones. For example, if the person is earning 50 naira and he wants to take 1 million naira loan, and he wants to take 1 million naira for he wants to take 1 million naira for 1 year, and he's earning 50 naira. If you add 50 naira times 12, that is 600 naira. But he wants to take 1 million naira loan. So if you look at it, you will discover that that one is more prominent, and on and on. So just for sake of, and everything must be equal to 100% the total weight. So I'm just going to put something, yeah, so that this thing I'm doing now is what every company should do in their credit policy. Yeah. So I assume that you have one. If you don't have one, Many companies that we have done this for, they don't always have, or they have, but it's not granular like this. They use the 5 C's. Yeah. So I actually have, so all of these things I'm doing, please, there's a survey ongoing that they sent. Please, I want you to fill it because they might need to send you these examples or the videos if you missed it out and the slides. So please, you can just fill in the survey that they actually sent. The survey, they sent you a survey just now on this same training stuff, a survey. So please fill the survey, put your information so that they can send you some of these things that we are doing, especially for the people that to an extent they were in for a couple of minutes and at a point they were out at the point in time. So this is the weight. So next thing will now be, what are the rates? Now, what I mean, what are the different responses? So in number of days past due, I should be having 0 to 30 days. I should be having 31 to 90 days. Please, let's just do it like that. And above 90 days. Don't worry, you can do your own better than that. But I don't want to type too many things. That is why I'm making them bigger. For length of service, you could have 0 to 5 years. You could have 6 to 10 years. You could have above 10 years. For type of company, you could have sole proprietorship. You could have PLC, you could have limited liability company, you could have unlimited, limited partnership, and on and on. Yeah. Gross loan as a percentage of loan. You know, if it is gross loan as a percentage of loan, you always want the loan to be bigger. So, for example, if somebody is taking 100 naira loan, or and his salary is 1,000, that means that if you do what is here, the gross salary as a percentage of loan will be in multiples. Like this one has 10 times. So the bigger it is, the better for the company. So let us say above 10 times. And 5 to 9.9 times, and 1 to 5 times, and 0 to 1. Now, let's leave it at that. Let's just put something here. Now, if we have done this, this is now, so which one would you want to give loan to? Who do you want to give loan to? Let me just assume that these are the ones that we did the loan, so that it is easier. Yeah, just these ones. Very well. Yeah. So let's assume I will reduce the percentage now. Let's assume these are the attributes. To make it 100, I will just add, let's make this one 50. Remember, I'm just typing something. Now, ratio of this, if I'm going to score this thing, which one should I score higher? Is it the loan that has above 10 times, between 5 to 9.9 times, 1 to 5 times, or 0 to 1 time? Please, I want somebody to respond. Who should I score higher? Who should I score higher? Oh,
Above 10 times.
thank you very much. So let me assume that I will give this one 3. And if I score this kind of people 2, this is what they call credit scorecard 1. And if I score 0, it means that we don't want to give loan to anybody that his salary cannot pay back the loan amount. His annual salary, for example, cannot pay back the loan amount because it's a salary-based loan and it's just 1 year. Sole proprietorship, who do you want to give loan to? PLC, sole proprietorship, LLC, limited partnership, partnership. Which one should score higher? I did not even put government. I should have put government. So which one should score higher? So what should I give sole proprietorship? Let's say it's between 1 and 5. Okay, so let me assume sole proprietorship is, I'm just putting something, so anything that you, PLC, let's say 5, you say 5, don't worry, anybody might have, this is now a function of the policy of your company, so yeah. Length of service, I want to believe that the more you are in the company, the more you are stayed, the more we want to give you. If you have stayed more in that company, that means that you also pay your loan. You won't run away. That's the idea. So number of days past due, we want to give higher marks to people that are that have let's say we don't want anybody to even default at all. Now, this thing is the credit scorecard. So let's now assume that we have 2 customers. Let's assume that we have customer A. So that means in this place, the maximum score is 3, 5, 3, 3 for this. That's the maximum score. Let's assume we have customer A and customer B. Let's call them. Because whenever we want to calculate probability of default, we will use 3 to 5 years data back because it's your data that will determine what the probabilities of default will be. It's your data that will determine what the probabilities of default will be. So let's try to use that to calculate this. So here, let's assume that this guy is a good guy. A is a very good guy. So let us call A. Let's call A highest. He scored 3 here, but he works in a limited liability company. And length of stay, he has stayed 20 years. So we give him 3. Here, because it's the beginning of the loan, he has not even defaulted anything. But you see, this B is a bad boy. He's a bad boy, so let us call him 1 here. Let us call him 2 here. Let us call him, he has not even spent 1 year. He wants to start collecting big loan. Let's say that he has not defaulted 2, at all. So let us say 3, because he's at the beginning. So let me assume that some of these are bigger so if I change this one to 30, that means this one will be 30. So I think everything should be 100 here. It's 100. So let us now calculate the A's credit score. So A's credit score is over 100 and is calculated as A score divided by the maximum score times the weight. So all these things I'm doing, they are actually on the slide, really. So we'll send you the slide too. So what I'm doing now is actually on the slide. So you can as well go ahead and see. So if I drag this thing down to the end, this is the credit score of A. So A's credit score is giving me 96%. So let's now do for B, B's credit score. B's credit score is what B score divided by the maximum score times the weight of that score. So if I drag it down, you will see what B has scored. So in this case, B has scored 55%. So this thing that we just calculated now, they are actually the credit score. They are not yet the PD. This thing is now what I will take into a statistical table and we will now use to calculate the PD. So this thing I just showed you now is the credit score. So now this credit score, please, do you understand how I calculated this credit score first? I want to get responses before I take it a step further. Do you understand how I calculate? Because the credit score is the beginning of calculating the PD. Do you understand?
Yes, sir.
Okay, so I can take it a step further. So let's take it a step further because don't worry, just fill the survey so that they can send you all this information. And I think you should join the next class because I'm trying to rush to finish. So let me just copy this out. So these scorecards that we have done, let me copy them to sheet 3. I want to use sheet 3 to calculate. So let me paste pressure and then transpose and place as value. So let me just copy it from here and from here. Let me go and paste it, transpose, paste pressure, values, transpose. So this one has now when we are doing calculating PD, what we tend to do is, so all these ones, let me put the name of their stuff. So it is ratio of this one. Let me go and copy them here so that you can still remember them. So these are the things that this course relates to. Now, all this one, let's assume these are our customers. Now, we will now need to go ahead and look at all of your loans and all of your receivables 3 to 5 years back to be able to understand the relationship between the people that have this credit scorecard that you have given those loans to in the past and whether they defaulted or they did not default. Because the relationship between the credit score and default or no default is what gives us probability of a default. So this thing now, I'm going to assume that this is A, this is B. So I'm now going to have different kind of A's, meaning I want to drag this thing down. I want to create multiples of this, meaning I'm trying to do as if there are many customers like this that we have given loan to in the past, and we have now weighted every one of them. We have weighted every one of them from the past. We went to go and weight them all. And by weighting them, we are able to get what their credit scores were. Let me just drag this thing down. We're able to get their, what do you call it? All of them, we weighted them from history. So let's assume this is A1. I'm assuming these are their names because I'm just trying to generate this data. Now here, we also have the information whether they defaulted during the, so these things are loans of the past. We know whether they defaulted in the past or they did not default. So let's assume this is default and it is 0 or 1. So let's assume that the first one did not default. Remember that these are actual data, so you have them already. This one defaulted. This one did not default. This one defaulted. Let us assume that is the way they did. Yeah. However, so that it is not too granular, I will make some of them to default intentionally, so that it's not too granular and it will not look as if I forged the data. So let's assume that even some of these people that they were good, they still defaulted. And some of the people that are bad, they did not default. Some of these people, they did not default. Yeah? So let's assume that was the way it was. So let's assume that this one, this one had 0. So I'm trying to change some of this data that is not, so that it's not too granular, but you can leave it. It will just give you a perfect score. Now, if you look at this now, these are historic data, your own historic data, and now I want to calculate the probability of default. So we have default or no default. How do we calculate PD? I have explained to you that PD is calculated as exponential of default over 1 plus exponential of default. So if that is the case, I need to first calculate exponential. Exponential is the logit. So I want to put logit here. Logit is Z. I don't know it yet. And I said probability of default, which is PD, is equals to, open bracket, exponential. If you type EXP in Excel, it will show you exponential. Exponential of logit that I don't know, divided by, open bracket, 1 plus exponential of the logit that I don't know yet. So this thing is telling me that as of now, it is 0.5. But it's not yet correct because I've not put any exponential here. So, because this is what I'm going to do here, another thing that we are going to use while calculating this is the log loss. Don't worry, I'll calculate it all here so you will see it. There's no idea here. Now, next thing is that to calculate logit is a logistic line. A logistic line we are using is because, and that is the Z. If you look here, you see Z is equal to beta plus B1 times X1. BO, B1, BO is the intercept. B1 to BK are the slopes. The slopes is the experience line. X1, X2, X3, X4, they are the credit score amounts. They are these figures that we have here. This one, ratio of salary to whatever, type of company, length of stay. That is X1, X2, X3. And remember the formula for calculating your regression. Your regression Y is equal to intercept plus X1 times C1 plus X2 times C2. That is what you are seeing here as the Z. Now, I don't know what B beta is. I don't know what B1 is, B2, B3. I don't know. But I can use a simple Excel formula. To do that, let me just bring all of those. Don't worry, I'm rushing you now, but in the full class, we are going to have 3 days to do simple regressions, and we have enough time and we can do that. If we can, we'll go to Arima X because all these things are used when you are calculating this. So we need to calculate the slopes of these things and the intercepts. And at the end here, I also want you to put log loss. So to calculate this in very simple words, the Z, like I said, is equals to intercept that I don't know yet plus coefficient of ratio as a percentage of salary as a percentage of salary times the score that is inside this table. Close bracket plus open bracket, the score of the type of company for that obligor times what I have as the type of company coefficient plus the length of stay coefficient times what I have as the length of stay score plus the number of days party times what I have as the number of days here. So if I close that, I can just, all of the ones that are on this P, I can make them to become absolutes. So let me press FN4 to make them, why am I making them absolute? So when I drag this thing, it should just remain because I don't want it to move. I want it to still be referencing the intercepts and the coefficients, all of the ones that are P. So I can just drag it down. Nothing has changed. You will see it whether it's right or wrong. And log loss here is calculated as, log loss is a deviation. So let me try to draw this for you so that you would understand. Let me try to draw a simple thing for you so that you can understand what log loss is. Trying to look for a biro to... Okay, let me try to go and draw it. I think this guy should have something I could use to draw. Oh, okay, so let me just use a simple Word document. So I can use. I just want to draw and explain to you what log loss. What can you see, please? Somebody said he can't see my screen. Please, can you see my screen? Please, can you see my screen? What can you see, please? So somebody said I can see. So if you can see, I can see. So the formula for calculating log loss is very simple. Somebody said I can't see too. So let me stop sharing and share again. I'm gonna try to let me share. Let me share again. Please, can you see my screen now? Please, if you can see, say I. If you can't see, say nay. The guys have it. That's the way they do in national assembly. When they're doing it, even when they are not at I. Please, can you see? Can you see my screen? Okay, so if you can see it now, then to calculate log loss is calculated as actual times the natural log of the PD you have calculated plus 1 plus actual times natural log Please, can you see my screen? So that's the formula for the log loss. You can see that I'm typing it in here. I'm not doing it. And you will see the figures now. On this side, I'll calculate the PD now. You will see it now. The log loss, average log loss here is equals to minus average of all the log loss that I've calculated. Don't worry. I need to explain all these things to you because I'm trying to rush, but just watch. This PD is 0.5 now, but when I'm done now, you will see that it will be correct. Watch. I put my cursor on log loss and I go to data. Under data, I click on solver. Under solver, I change set objective. I ensure that it's on average log loss and I put I say minimize, because what I want to do is to minimize the deviation between PD, the deviation which is measured by log loss between PD and the default or no default. So I'm going to tell Excel to do an iteration by changing the intercept. You know, there's nothing inside intercept and coefficient. There's nothing there. So I'm going to tell Excel to change it to an optimal one that will make the log loss to be at the lowest. That is what I've told Excel. So here, I will say make unconstrained to be non-negative. And I will ensure that this thing is on GLG non-linear. Why? Because what I'm trying to do is actually a non-linear regression, which is a logistic regression. And the reason is because people that have money might not pay. People that don't have money might go and borrow to pay you back. So it's not a linear regression of if you have money, you will pay. Okay, that is I'm using GLG non-linear, and I'll click on solve. The moment I click on solve, Excel will solve it for me. Excel is done solving it. Remember, when I started, intercept to this place, there was nothing there. Yeah? Now, I want you to now come and look at the PD. The PD is no longer, before when I started, the PD was 0.5. But come and see what it is now. Now, watch. You will discover that they are not, watch. When look at it, this is default. When the default is 0, you will discover that the probability of default is 0.09. When it is 1, the probability of default is higher. Can you see the relationship? Meaning that this thing, if you look at it, whenever it is default, the probability of default will also be very high. Meaning that if you bring attributes of somebody that looks as if he might default. This model will give you a probability of default based on the history of how you have been given loan. It will give you and calculate the actual thing for you. That is what I have showed you. That is how to calculate probability of default. Now, I know that some of the things I did here, in all sincerity, I rushed them, and I don't like to rush. This is a 3-day class for us, but I just have 2 hours to do this, and I only have 7 minutes left. So this is what I'm going to suggest. We're going to send this Excel sheet, and we're also going to send the slides so that you can use it. Then we are going to have a full class of this thing between 11th and 13th of March. We also have an internal controls over financial reporting coming up 18th to 19th of March. All I want you to do is to just register to attend the full classes. Because in all sincerity, I have 7 minutes, and this number of minutes remaining, I think I want to use it to take questions, because I can't do all this in just 2 hours. I'm going to stop at this point. And please, admin, can you send that survey again so that you will be able to get the slides, the materials, the recordings, and also the Excel sheet I'm using. Please, can you fill the survey? They dropped a survey here before. Admin, please, can you drop it again? It's in the comment box. Just go there, fill in the information so that basically they can use that to send an email to you. And I want to see you at the next full class. Yeah? Any questions for me? Now I want to take questions because I know that many of the things I did were a little, they look like magic, but it's not magic. It's just simple statistics. Questions for me now? Okay, can go ahead, please. Questions for me now? No questions for me? Okay, calculating this might look a little bit fuzzy here, but in addition to that, we have Excel templates that all you just need to do is to just put in your data and you click on run. So I think I have examples of that. We have Excel templates. All you just need to do is to just click and just run. Just click and run. I just want to show you. Let me just open one. So all you just need to do is to put in your loan books, click and run. You don't need to stress yourself with all the things I just showed you because they are macro-enabled, macro-enabled templates. All you just need to do is to click and it will run it. And you can also do it yourself. So you can ask your question, Dorcas, please. You can ask your question. Dorcas, you have your hands raised. That is why.
Can you hear me?
Now I can hear you.
Can you hear me now?
I can hear you perfectly.
Oh, okay. So thank you for the class. I really appreciate, even if I was in and out at some points. I've not gotten the survey link in the chat box.
Okay, the survey link, admin, can you put the survey link again on the? So this is an Excel template. All you just need to do is to just put your data and click on run CD, run all this. You don't need to stress yourself. Admin, can you put it back?
Okay, so I want to ask that this ELC model would work majorly for companies that maybe give out loans or financial institutions, right?
No, so basically, like I said when I was doing the scorecard, I said for receivables too, we'll do the scorecard, but the credit score attribute will be different. For receivable, for example, the credit scorecard attribute will include things like like number of days past due. We include things like type of company that you are doing business with.
Yes, yeah, because my company, we are,
And you can just use that Excel. There are Excel templates that you can just use, then you
okay,
will
okay,
run the
because it's the receivables that will work for me, because we are retail companies and we distribute and sell, and we have customers that sell on credit. So basically, the receivables is what I'm going to make use of running my forecast and analysis.
So the template will also run for receivable.
Okay.
Okay.
Thank you. Thank you.
Any other questions? Any other submission? Okay, if no other question for me, I think I'm done for now. Thank you very much. Okay, Baba Jide, you can ask your question, please. Baba Jide.
Okay, thank you. Thank you very much, Mr. Akinto. Thank you very much, sir. Thanks for the presentation and the opportunity to learn more about this ECL. Now, I want to ask you, the exact template that you have, can it be adopted for receivables for businesses that are not financial institutions?
Yes, that is what I just said. I said, so the only thing that will be different, and that is why the template I was showing you is a template that can, so for example, when you engage us to give you those templates, the credit attributes of a receivable is what is different from a loan, but they are both measured at amortized cost.
Okay.
The credit attribute will not be the same thing, but it's the same model, if you understand.
Okay.
The only thing is just that the standard says we can do the simplified, and with the simplified, we don't need an LGD. Why? Because the assumption is that the receivables are expected collectible within an accounting period. So it's the same ECL. So the template works for it. Let me just summarize it like that.
Okay, we appreciate that, sir. Thank you so much.
So the template. So if you want us to actually give you the template, you want to have the example I painted for you here is not the template.
Yes,
so what I did was teaching you how to calculate. So, but if you want that template, the template is actually used by a lot of companies. We have two whatever. There's a software and there's an Excel template. So the Excel template will work for in a situation where you don't have up to 200,000 lines of receivables or loans. It will not hand. But in a situation where it is now like 1 million loans or 2 million loans, you can't use that Excel template.
Okay.
Excel will start hanging. So you can also fill it. Please check the Google form. If you want us to send you the Excel template, you want to also be able to use it, you can just contact us. You can fill that in the form.
Okay. Thank you, sir. Thank you very much, Mr. Akinyelu.
Okay. Any other questions for me? Because it's actually for one. And as I was taking the class, I have a lot of missed calls. And I have another class shortly. Any other questions? Okay. So thank you very much. If no other questions for me, please just fill the form. And I want to believe that we'll be able to get back to you immediately. Yeah. So I'll be here for any other questions. Please, the recording will be sent to you. Just fill the form that is right here, and we'll be able to get the information to send it to. Okay. Okay. Have a lovely, lovely day, and I'll be meeting now. Have a lovely day. Bye bye.
Bye bye.
Have fun.
Yeah, well done. Thank you.
Thank you. Bye.